Welcome to Unfiltered Finance. We have Chris Pulver with us today, and we are talking about something that has been in the headlines quite a bit, and that's interest rates and whether they're cut or whether they're hiked. Who knows? We keep going back and forth. A lot of investors, Chris, built their portfolio strategy around rate cuts arriving, and it does not look like that may happen, and certainly not anytime soon. So, why don't you quickly walk us through what happened and where we're at the moment?
2026 thus far has been an interesting year. We have had a pretty healthy correction, and hopefully it's just going to be that, a correction, because it certainly looks like it's shaping up to be more uncertainty, more de-risking, more deleveraging. Sectors that are leading the way this year in 2026 are certainly different than in the past. The U.S. has clearly cemented itself as a tech and service-based economy with Mag 7 stocks and top 10 stocks, trillion-dollar companies leading the way and leading everybody to the promised land with the indexes going higher. That all changed really late last year when the NASDAQ formed a high and hasn't been higher since. The S&P had a limited market breadth high. This year we hit 7,000 in the S&P, and we've been down off that high right to the tune of almost exactly 10%. So we have, and I think last time I talked to you, Emily, we had a discussion on the dispersion trade, which is where the S&P and the NASDAQ were very calm on the surface, but underneath you had stocks swinging 10, 15, 20% one way or the other. And the software disruption, the AI disruption, all that was a talk 30, 45 days ago. Now it's all about Iran. Now it's all about the US and Iran. Now it's all about the Strait of Hormuz. Now it's all about oil disruption. Now it's the potential global shock of inflation rearing its ugly head again. And that was a monster that we kind of tamed through 2022 and 2023. But if it sticks its head up again, you're now dealing with much higher prices and everything, with oil prices at $100 a barrel. Oil is in literally everything. I'm not a believer that the oil prices are going to $150 to $200 without having some major changes. But if it gets there, that's an intense shock. I'm also not in the camp that this is going to go from $100 as one-time sticker shock and it goes right back to $60. I think we are stuck right now with some major infrastructure that's been damaged. And that brings me back to what you just said with the Fed. They don't know what to do. The Fed doesn't know what to do. They're kind of backed against the wall. And Powell is out in 60 days. I mean, he's no longer going to be Fed chair. Kevin Warsh steps in. He is going to be handed a situation where it's like, what do you do? And so the futures market is pricing in zero cuts for all of 2026 and mostly zero cuts through about October of 2027. And the market for a moment was pricing in the Fed might have to raise rates. And so the Fed doesn't really know what they're doing or what to do. The markets are up in the air. And that's what I'm saying. Like, all this is on looking at the indexes. We've had a correction. That correction could easily become worse. But Trump has an amazing way of kind of backstopping this market. I think that he is the first line of defense to talk this thing like, hey, it's not that bad of a conflict. We're doing everything we want. It's all under control. I've got a plan for everything. So that's what he says. And he's very vocal at that 10% correction level because the market ended on a pretty nice quarter with some major defense. But still, I am very cautious right now. I'm seeing a lot of risk management overlays that are basically calling for limited exposure in stocks and going more into safe haven stuff, which I'm not a safe haven trader, but I certainly know when to reduce my exposure and de-risk and deleverage.
Yeah, I mean, it's interesting because it almost seemed like rate cuts. I mean, we had a rate cut early. Trump was really bullish about another rate cut. That was a whole part of the Fed chair thing. Uh, but now it looks like this is going to be the long haul. So for folks and investors who were planning on that rate cut happening and it's not going to, should they be concerned? And what is the first thing they should be looking at?
Well, so concerned, I mean, here's what I'll say. I'll put the camp in there. There's two different types of profiles here. One is, if you're an investor, you should be concerned there's going to be some near-term pain ahead. I think that this dispersion trade, this disruption, this correction could certainly get a little bit worse. The one wave that nobody likes in the market is not the first wave down, but it's the next wave down. So if we go, let's say high to low, I'm not showing a chart here, but just go high to low, lower high to lower low. It's that next low that probably causes the most pain and anguish and frustration in the markets. So for an investor, if you want to avoid that stuff, it's probably safe just to sit on the sidelines and be parked with some cash. There's a couple good vehicles out there. You could be on BIL. That's the ticker. It's basically a 1 to 3 month treasury mix. You could be an SGOV, same type of thing, 1 to 3 month treasury mix. You could be in USFR, same type of thing. Those are offering anywhere between about 3.7 and 4% risk free. And they settle every 30 days. And so you're going to get a little bump, about 1/3 of 1% every single a month. And that's just on the sidelines with cash that's at least working for you if it's unallocated. Now, I don't know what the bottom is, and nobody does, but I do wonder if April 2025 lows is possibly something that this market really is on the brink of falling. I think April 2024 lows are potentially in the play, in the cards. And so that's a 30+% correction in the markets. Now, I'd love to start there as an investor. If I'm an investor that's saying, okay, I'm going to sit on the sidelines and be a little bit safer right now, I'd love to invest at a 30% discount and start, dollar cost averaging back in and starting to reallocate my percentages to build my portfolio back up. Now that's the investor camp. Like, I'm cautious right now as an investor. I think that dispersion, disruption, uncertainty is going to continue. I'd be shocked to see the market get right back to 7,000. The S&P, I think we're going to make lower highs and lower lows right now. It might feel a little bit like 2022 with that like type of trend we saw for 10 months. As a trader, however, this market is a trader's paradise. It's scary, yes, but if you buy puts, if you trade directionally, this market has given us countless opportunities, not only in indexes now, also in individual stocks. There is movement everywhere. And if you like to trade, if you like to trade options, up, down, and sideways, you can take calculated bets. And I mean, this is what I've been doing. I've been, blending the two between investing wise, I'm cautious, but trading wise, I'm extremely active.
So when it comes to where the vulnerability is, I mean, are there certain sectors per se that are going to be more affected by the fact that we're not going to see rate cuts?
So, I mean, I'll just go off the start of the year. I mean, what led us sector wise right now. I'll share the screen here because this is I think everyone thinks like, oh, the market is down and the indexes are down, so everyone assumes that everything's bad. Energy is absolutely crushing it right now. We saw energy, the sector itself, XLE was up almost 40%. It's still leading the charge by a long shot here. Look at your consumer. See your consumer discretionary, information technology, communication services. These have some of your Mag 7 stocks tucked away in here, also with technology. So technology, down almost 8%, discretionary down almost 9%, services down almost 6%. Mag 7 stocks are calling the lag 7 now because they're underperforming. Energy, the problem with energy is though market cap wise, it's not big enough to carry the entire index. So we can have energy stocks that are crushing it to the upside, but the indexes themselves are not going to go higher. We cannot, Emily, we cannot go higher and probably make all-time highs in the markets without Mag 7 stocks participating, without big tech and big, top 10 companies starting to at least show stability. So, I mean, truthfully, we probably need to see NVIDIA hold its lows, Google hold its lows, Apple hold its lows, Tesla, Amazon, Meta, Microsoft, they all need to show like better price action in order for those stocks to show that there's more gains out there to drive those, market cap weighted ETFs like SPY and Qs higher. But energy has been a great play. It was a nice way to diversify out of Mag 7 late last year, and that's working out pretty nicely. But the issue is if this continues, where all these, energy, materials, utilities, all these like scarcity sectors, all the physical side of AI, all the stuff we don't have, like we're trying to build out the energy infrastructure, data centers. It's funny how that was all the rage, 2-3 months ago, and now it's all about what's going to happen to this war in Iran. What's up with this conflict? We're gonna have this be like 4 to 6 weeks? Is it going to be tamed? What about midterms? Like so much uncertainty swirling. My point is, if we are seeing these sectors lead the way, that's not a typical healthy bull market. The last time these did very, very well and outperformed everything else was in 2008. And that was before the top. So you talk about, 2008, the market pulled back over 50%. This could lead us into a topping pattern that is ultimately going to be like a pretty nasty downside in the market. And as far as where we're at price to earnings wise right now, we could see still multiple compression to the downside. We could see the S&P, from a 25 price to earnings down to maybe a 15, 14 price to earnings. That we're talking levels that are pretty scary. Like S&P could be down to sub 5,000, 4,500. Nobody wants to see that. And so I think, like I said, Trump is the first line of defense, but I don't know if the Fed is really going to be effective in this market because we have such strong fiscal policy right now that the Fed they just don't want to mess up. And I think even with a new Fed chair stepping in, I don't think Kevin Warsh is anything more than a loyalist and a yes man, but I don't think he can cut rates. I really don't. I think if you cut rates, you're going to end up having to raise rates because you're going to do too much too quickly. And again, they don't control the long end of the curve, which has been going up. They only control the short end of the curve. But all this stuff to me is like, it's all funny money. And I think eventually if the Fed is going to cut rates, it's just a short end. It's trying to get maybe some liquidity back into the system. I think last time you and I talked about the private equity space a little bit. That's still out there scaring everybody. I mean, if you stack up all the wall of worry items, it's a lot. It's a lot that we should be concerned about. But I also think that we have a lot of resiliency in the market. We still have tons and tons of liquidity. We have backstopping mechanisms. We have levers to pull. So don't bet against market resiliency. But like I said, a little bit of caution, a little bit lower exposure, trading smaller, probably the safe approach for right now. And I'm not a trader that's like, I just want to be in the sidelines. Like, I'm a trader that's going to get in the trenches and grind this stuff out. But for the average investor, I don't think it's necessary to take big risk right now. I think if you want risk, take it when it's at a discount, get a 20-30% correction in the market eventually, and start from there, because that's how you make a ton of money on the upside. But when we're only, 6, 7, 8% off all-time highs, and that just happened the last 30 days, it's not a time to be, taking a big bite out of the risk portfolio.
Well, let's talk directly to those types of investors, right? Because you talked about how, yeah, there's a lot of scary things that are happening right now, but there is opportunity. So, kind of walk me through actual moves that if someone comes to you today and, they were like, well, I was hoping for this and that doesn't look like it's going to happen. What are the like first 2 or 3 things that you would tell them to do?
So right now, I would say I had this conversation this morning in one of my live sessions. I was asking everyone, like, who can confidently say out the next 5 years, what stock would you own? And I had some people that participated, and I've got hundreds of people that watch me every single day, and great. So they listed a couple tickers, and I'm like, I don't agree with any of those. And the reason why is, like, there's not a single stock that I could pick and say in 5 years that stock is still going to perform as well or better than it is right now, i.e. the Mag 7, for example. I think the amount of disruption and uncertainty ahead is as high as it's ever been in my career. Like, I don't know if NVIDIA is going to be the same company 5 years from now. I just think there's too much room for disruption. I think the S&P will still be around. Obviously, the NASDAQ will be around. But what I'm finding interesting is all of these potential startup companies, small cap companies that never want to go public. They never want to be traded in the Russell. They never want to be part of the S&P 500. They want to just be, hey, I've got 5 or 10 employees, AI agents to the tune of hundreds of them, doing all our bidding and being productive, and maybe making 10, 15, $20 million a year. Never need to go public. I think that could be like the new job in the next let's say 5 years.
Well,
But
the labor market is certainly reflecting that.
we haven't had, and honestly, you talk about that, like the last year. This is the sad part, is like we're being told it's a low fire, low hire. It is definitely a fire. Like, people are getting let go. There's layoffs happening. I hope those
Oracle
people are going to
just
bounce
dumped a
back
ton of people. Yeah.
with like a 6 a.m. email. It was just like, here, happy April Fools, but it's real.
Yeah.
But to be fair though, it's like the bounce back and the resiliency and the responding to that adversity is be an entrepreneur. I think there's opportunity here. I think that there's, I mean, again, the AI space, I'm not going to sit here and like brag that AI is the greatest thing. It's like, I'm still learning through the process too, to figure out what I can do with it and what I can use from it. But I think if you have that, like, working mentality, entrepreneur spirit, you can bounce back and maybe be for the better, like be your own boss type thing. But the indexes will be around. I'd say that the one thing I'm willing to invest in the next 5 years, I'm going to put money in gold. I'm going to put money in silver. I'll put money in scarcity. I think that the commodity space is a really good trade. I think gold and silver are great. I think if you're trading copper, if you're trading platinum, palladium, if you're trading, I mean, even agriculture, fertilizer prices are up 52% year to date. That's what also happened with the Strait of Hormuz in Iran. It's like there's major disruption across the board. Helium prices are going crazy right now. So that type of weird, like, physical demand side is investable. And I think that's a good play right now to carry us on through 2026 as things are majorly disrupted. I think the oil trade has a short lifespan. I think if you get oil for the next 3 to 6 months, that's great. Have a huge gain on it, but certainly protect your profits, because I think it's going to be short-lived, because eventually higher prices will force us to move away from oil faster. So we're at $100. People are talking about $150 to $200 oil shock. If that happens, we will move so far, so fast away from oil and try to redo everything without it. And it's going to be, incredibly innovative, but it's going to be a lot of pain along the way. So I think that right now it's kind of right on that cusp. And this is how simple the market could be. If oil prices are going to sustain over $100, equities have a ton of pressure on them, and they'll probably go lower. If the oil market can drop sub 100, let's say back to 90, back to 80, I think the market can kind of find another equilibrium and find a stability point. It's still going to have some pressure, but way less pressure than oil prices going up. That's an interesting correlation right now. So gold,
So when
silver,
you're,
long term for sure.
yeah, so you sound like Jeff Smith, who's also on this channel.
Yeah, I know. He talks about it a lot, but I truly 5 years. I'm like, I think they're good plays. Like I look, I took a ton of profit on gold and silver after a 4-year run. I was invested as a campaign trade for like 4 years. I took a lot of profit late last year, rode the silver highs up to these recent like blow off tops, but I'm looking to build back those positions. And so I'm just starting as like, I'm kind of price inelastic to gold and silver. I just know that I want to get my allocation back up to like 5% of my portfolio in each one. And so I'm going to start dollar cost averaging, taking some futures trades, take some option trades on the ETFs. And obviously, if you want to get the physical stuff, that's fine. Buy your gold and silver bars from Costco if you want to.
Well, yeah, right. God love Costco, man. Big fan. So when you're looking at where you're going to put your money,
Mhm.
but for folks who have no idea, right? You're looking
Yeah.
at where you're going to put your money. What are the tools that you use and how do you figure out where that goes so that they can copy you if they want?
Sure. So, as I said before, there's a big difference between an investor and a trader. And so I have plenty of services right now that are trading specific. So, guess what? The market is down 10%, and I'm profitable on all of my services because we've been trading through all of this stuff. So, we trade the markets every single day. Zero DTE is the fancy name for 0 days to expiration. We can trade indexes every single morning based on, index options have been around since 1981. Market efficiencies are built in. Emily, we had a win streak of like 55 out of 58 trades, 55 out of 59 trades in the last like 2 or 3 months. I looked at the quarter. Just for the simple tracker that I have, we're up like $8,700 for the year on just a simple one contract trade with one of my services that trades every single day. It doesn't win, but we win about 90% of our trades. So we have occasional losses, but we win a lot. I have another service that we had one loss in 2025 during Liberation Day, and that was because we had previous expirations. But during that dip in February, March, April, we took one basically chunk of losses, and we had 9 months, 10 months after that were all winners consecutively. So that wins about 95% of the time. So whether you're trading, every single day or every single week, I have those kind of income-based services where I know that I'm going to get in the markets and grind. And so if a trader is willing to jump in and, take defined risk and figure out, okay, I don't need to allocate my entire portfolio to this, but if I can take, $5,000 risk capital, $2,500 risk capital, $10,000 risk capital, and let's try to make $50 a day. Let's try to make $100 a day. Let's try to make a few $100 a week. That's very doable right now in this environment because we have good volatility. It's great for premium selling. You can stay out of the way. You can make it a binary result where it's like, even if the market does something silly, we're still going to be okay. We have defined risk. We can't get blown out, but we're going to trade probabilities and most likely win as a net result.
And so for the people who, you know, are feeling a little bit better about it after this conversation, or those who may still be scared, I mean, what are your parting thoughts to folks on this topic?
That parting thoughts are there's ways to survive this. Truly, I mean, I have traded. I mean, I've been in the market since 2000. I mean, I didn't know what I was doing. It's like I just was participating for the first, 3, 4, 5 years of my trading. It was passive investing, but I've been way more serious about it post Great Financial Crisis, 2008, 2009. Started trading everything, including currencies and stocks and options and futures. So fast forward 16, 17 years. I'm not saying I'm well equipped for everything, but I've certainly seen a thing or two. I've seen this playbook happen before. I feel like this could be a rhyme of 2022, maybe a reflection of 2008 if it gets bad enough. So I'm prepared for that. Like typically my approach is plan for the best, prepare for the worst. And I'm always cautious. And it's not that I'm not cautious and conservative on my risk as far as I just know that here's what I'm comfortable with. I'm going to stay in the game, keep trading, keep grinding, and know that eventually if I do the right thing with good probabilities, the markets tend to do it. I mean, we have historical edges that are in our favor. If you are bullish in the long run through bull and bear markets, 71% of our years have been bullish. So yes, there's the occasional downtick, but even this with all the scariness and all the uncertainty is still going to lead us into if you have capital and dry powder to scoop up some discounts. Stocks are on sale, tons of them. Indexes are on sale a little bit. I think I think the discounts could get bigger on the index side. But if you can start at a 10, 15, 20% discount on indexes, we're probably going to go to all-time highs, right? Eventually. Maybe it takes 6 months, maybe it takes a year or more, but we'll get there. And I think you have to have that faith and confidence that this financial market in general, not just the US, but the world, it's too big to fail. There's no rational reason that the market has to go higher. There's no rational reason the market can't go lower. But ultimately, you're betting on innovation. You're betting on technology. You're betting on this whole future of AI. It's like it's going to show up in the market somewhere, and I think it's going to show up to like productivity boosts, earnings, profits, and margins. And like I said, to the downside is maybe we have a really messy, stally labor market. But if the entrepreneurs take it and run with it, I feel like you still have a prosperous existence as far as like we as humans have a purpose, we have skills, we have critical thinking, and we can survive in the business landscape. But as an investor, I feel like you're still going to reward the companies that do this well. And I think that's why all this spending, all this investing is so like full tilt spending, because you can't afford to miss out on this like next leap in innovation. But that's why I don't want to pick an individual stock. I don't mind taking little base hits on individual stocks, but I want to trade the indexes because that's who ultimately benefits. It's the haystack, it's not the needle. So I'm a glass half full type trader. I know that with this uncertainty and the scariness of nobody knows what to do, and I get it. Like, but I'm right there every single day with my followers, with my members, running these services for what reason? To try to make money. Up, down, sideways, we can do it. Define risk. I mean, I know I'm not perfect, but I do win a lot of trades. I'm super competitive, and I try to teach the same type of methodology where we trade probability, statistics, and we trade and we grind, and we're going to log thousands and thousands of trades. We're probably going to come out ahead.
Awesome. Well, we'll include all the information for your show and everything else if they want in the description below. But Chris, thank you so much for your time. And thank you guys for watching. If you liked this, we want to hear what you have to say about how you're planning for interest rates. Please put that in the comments below. Also, what else you'd like to hear on our channel. And as always, please hit like and subscribe.